Your bank looks stable, reports profits, passes stress tests, maintains capital ratios above regulatory minimum. The balance sheet shows assets exceed liabilities. Everything appears fine until you look at what they're not required to disclose: unrealized losses. $620 billion in losses sitting on bank balance sheets, not marked to market, not recognized as losses. Just sitting there waiting. These are losses on bonds, treasury securities, mortgage-backed securities, bought when interest rates were near zero, now worth far less because the Federal Reserve raised rates to 5.5%. But banks don't have to recognize these losses unless they sell the bonds or unless depositors demand their money. Then suddenly the losses become real, realized, catastrophic. This is what killed Silicon Valley Bank in March 2023. $16 billion in unrealized losses. A depositor-run forced asset sales collapse in 48 hours, but SVB wasn't. Unique, wasn't poorly managed, wasn't an outlier. They were just the first, the canary in the coal mine, because every bank has these losses, every bank is vulnerable, and the liquidity that would save them ... is disappearing. Liquidity is the blood of the financial system. The ability to convert assets to cash, to meet withdrawals, to fund operations. Without liquidity, banks die. Doesn't matter how much capital they have. Doesn't matter how profitable they are on paper. If depositors want cash in the bank, can't provide it, ... the bank fails. And right now, the financial system is bleeding liquidity systematically, structurally, intentionally through Federal Reserve policy, quantitative tightening. The Fed is draining $900 billion annually from the banking system, selling bonds, not reinvesting maturities, shrinking the balance sheet. This removes reserves, reduces liquidity, makes banks more fragile. At the same time, the Treasury General account is absorbing liquidity as the government runs deficits and issues debt. Money flows from banks into Treasury accounts, further draining reserves and the reverse repo facility, where money market funds park cash overnight, has been running at record levels. Over $2 trillion at its peak. That's $2 trillion not circulating in the banking system, not available for lending, not providing liquidity. All of this creates a vice, squeezing banks, reducing their ability to meet sudden demands, making the system vulnerable to the very thing that kills banks fast. This investigation analyzes Federal Reserve data on bank reserves and liquidity facilities, FDIC reports on unrealized losses, analyses of the March 2023 banking crisis, and overnight funding market indicators. All sources documented in the description below. The liquidity abundance you've lived through for 15 years ... isn't normal. It's artificial, created by the Federal Reserve's response to 2008, when Lehman Brothers collapsed and the financial system froze. The Fed did something unprecedented, quantitative easing, QE, buying trillions in bonds, flooding the system with reserves. Banks suddenly had excess cash, more than they needed, more than they could lend. The reserve balances at the Fed went from less than $50 billion before the crisis to over $4 trillion at the peak in 2020, $4 trillion. Banks were drowning in liquidity. Could meet any withdrawal. Funded loan. The system was saturated, stable, safe, but artificial, because the Fed was creating money electronically to buy bonds, injecting liquidity that wouldn't exist in a normal market. And this continued for over a decade. 3 rounds of QE, then the pandemic. Another $5 trillion in emergency liquidity. The system became dependent, addicted. Banks stopped worrying about liquidity management, stopped maintaining liquid assets because reserves were infinite. The Fed would always provide until they didn't. March 2022. The Fed started raising rates from 0 to 5.5% in 18 months, the fastest hiking cycle since the 1980s. And they started quantitative tightening, draining reserves, reversing key. The balance sheet began shrinking from 9 trillion down to 7 trillion currently. That's 2 trillion drained, gone. removed from the system. And every dollar drained is one less dollar of liquidity, one less dollar available to meet withdrawals, one less buffer against crises. Banks didn't adjust quickly enough, didn't prepare, didn't anticipate what rising rates would do to their bond portfolio because they'd bought long duration bonds when rates were zero. 10-year treasuries yielding 1%, mortgage-backed securities yielding 2%. These bonds lost 30 to 40% of their value when rates hit 5%. Not because of default risk, just math. Bond prices fall when rates rise, and banks were holding trillions in these bonds. The losses accumulated, unrealized, invisible, until they weren't. Silicon Valley Bank understood tech startups, venture capital, innovation. They didn't understand interest rate risk, held $120 billion in securities, mostly long duration bonds. When rates rose, those bonds lost value. By early 2023, SVB had $16 billion in unrealized losses, 25% of their tangible equity. If they sold the bonds to meet withdrawals, the losses would become realized, would wipe out capital, would make them insolvent. So they did what banks do, held the bonds, classified them as held to maturity, reported them at purchase price, not market value. Regulatory accounting allowed this as long as they didn't sell. The losses didn't exist on paper. But reality doesn't care about accounting. Depositors started withdrawing. Tech startups burning cash, needing liquidity. SVB had to sell bonds. She had to raise capital, announced a capital raise. And the announcement triggered panic. If they need capital, they must be in trouble. Depositors ran, withdrew $42 billion in one day. SVB couldn't meet the demand, sold bonds at losses. Regulatory capital evaporated. The FDIC seized the bank. 175 years of banking history gone in 48 hours. And it wasn't fraud. It wasn't crime. It was just interest rate risk meeting a liquidity crisis. If you're starting to understand that every bank has these unrealized losses, that rising rates created a time bomb on every balance sheet, and that the Fed is draining the liquidity that would prevent more failures, then you need to see what happened next. Subscribe now, because SVB wasn't alone. 2 other banks failed the same week, and the emergency measures the Fed deployed are expiring soon, leaving banks exposed again in this time. The losses are even larger. Signature Bank failed 2 days after SVB. Billion in assets, heavy crypto exposure. Contagion from SVB caused depositor panic. Withdrawals accelerated. The bank couldn't meet demand. FDIC closed it on Sunday, same weekend as SVB. Then First Republic, $230 billion in assets. Wealthy clientele, high uninsured deposits. Depositors fled after SVB. $100 billion withdrawn in weeks. JP Morgan and other banks deposited $30 billion to stabilize it. Didn't work. The bleeding continued. Eventually, the FDIC seized First Republic and sold it to JP Morgan. 3 banks, over $500 billion in assets, failed in 8 weeks. The 16th largest bank failure in U.S. history, the second largest, all in 2 months. And they were sound by regulatory standards, met capital requirements, passed stress tests, but had unrealized losses, had uninsured depositors, had vulnerability to a run. That's all it took. And the question everyone should be asking, how many more banks have the same vulnerabilities? The answer is terrifying. Almost all of them. The FDIC tracks unrealized losses, reports them quarterly. As of Q3 2020-3. The banking system had $620 billion in unrealized losses. Not 620 million, 620 billion on held-to-maturity securities alone. If you include available for sale securities mark-to-market ... it's worse. These are losses that would be realized if banks had to sell, if depositors ran, if liquidity evaporated. Small banks are more exposed. Community banks, regional banks, they hold more long-duration securities as a percentage of assets, more vulnerable to rate increases, more likely to face runs if panic spreads. But large banks aren't immune. They have more sophisticated hedging, better liquidity management, but they also have more complexity, more derivatives exposure, more interconnection. If a large bank faces a liquidity crisis, it becomes systemic immediately. Too big to fail. Becomes too big to save because the amounts are astronomical and the Fed's ability to provide liquidity isn't infinite, despite what they claim. The Fed's response to March 2023 was revealing they created a new emergency facility. Bank Term Funding Program, BTFP, banks could borrow from the Fed using bonds as collateral. But here's the key. The bonds were valued at par, at purchase price, not market value. A bond bought for $100, but now worth $70 because rates rose. Could still be pledged for $100 at the BTFP. The Fed lent against the fiction, not the reality. This allowed banks to get liquidity without realizing losses, without selling bonds at market prices. It was a bailout disguised as a lending facility, and banks used it. Over $160 billion borrowed within months, proving they needed liquidity badly. But the BTFP was always temporary, announced for 1 year, expiring March 2024. And it is not being renewed. After March, banks lose access, have to find liquidity elsewhere, have to manage with existing reserves, which are shrinking because the Fed is still doing QT, still draining liquidity, still squeezing the system. The emergency program provided a bridge. Now, the bridge is ending, and the crisis that required the bridge hasn't been resolved. The unrealized losses remain. The rate vulnerability persists. The liquidity shortage continues. We're exactly where we were before. SVB failed, except with less liquidity, less buffer, less time, and there are more vulnerabilities now. Commercial, real estate, office buildings, malls, hotels, values collapsed during the pandemic. Work from home killed office demand. Retail struggled against e-commerce. Hotels faced travel destruction. Loans secured by these properties are coming due, need refinancing, but at 5% rates instead of 3%. The debt service doubles. Many properties can't support the higher payments, can't refinance, default. And who holds these loans? Banks, especially regional banks, community banks. Their loan books are heavy in commercial real estate. As defaults rise, losses mount. Capital erodes. The unrealized losses on securities are joined by realized losses on loans. The squeeze tightens. The fragility increases. And regulators know this, are monitoring closely, have expanded watch lists, increased examinations, but can't prevent what's coming. Can only observe, document, prepare for receivership. Do you see the trap? Banks are caught between two pressures on one side. Unrealized losses making them technically insolvent if marked to market. On the other side, depositors who can move money instantly to higher yielding alternatives. Money market funds paying 5%, treasury bills paying 5.5%. Why keep money in a bank at 0.5%? Depositors are rational, are moving funds slowly, steadily, draining deposits. And every dollar that leaves is one less dollar of funding, one less dollar to meet the next withdrawal. Banks must offer higher rates to compete, but that compresses margins, reduces profitability, weakens capital, and math doesn't work. Can't pay 5% on deposits while earning 3% on old mortgages and bonds. The spread is negative. Every deposit is a loss. But without deposits, banks can't function, can't lend, can't survive. They're trapped between insolvency from unrealized losses and illiquidity from deposit flight. And the Fed's policies, make both worse. High rates create the unrealized losses, and the high rates attract deposits away from banks. It's a vice, tightening, squeezing, killing banks slowly, until suddenly, the overnight funding markets tell the real story. This is where banks borrow from each other, day to day, to meet reserve requirements, to fund operations. When liquidity is abundant, rates are stable low.com/when liquidity is scarce rates spike. Volatility increases. Fear appears. And we're seeing stress. The secured overnight financing rate So FR has shown volatility, unexpected spikes, suggesting some banks are struggling to find funding. The repo market, where banks borrow against securities collateral, has seen rate jumps, particularly at month end and when banks window dress balance sheets, when regulations bite. These are early warnings, not panic yet, but tremors. indicating stress beneath the surface, suggesting the liquidity tide is lower than acknowledged, that some banks are closer to the edge than they admit. And if one fails unexpectedly, if a run starts, the overnight markets freeze, just like 2008, just like 2020 during the pandemic. Except this time, the Fed has less ammunition, less flexibility, can't cut rates from 5% to 0 and restart QE without admitting inflation isn't controlled, can't flood the system with liquidity without undermining their credibility. They're trapped too between preventing bank failures and fighting inflation, between financial stability and price stability, and they're choosing inflation. For now, which means banks are on their own, vulnerable, exposed, waiting for the next shock that will come eventually, always does. If this has revealed that the banking system is sitting on $620 billion in unrealized losses, that the Fed is draining liquidity while emergency programs expire, that commercial real estate defaults are rising, that deposit flight continues, and that overnight funding markets are showing stress, then you need to know what happens when the crisis breaks. Subscribe now, because the next investigation reveals what the Fed will do, the emergency powers they'll invoke, the programs they'll restart, and why none of it will work this time. Because the debt is too large, the system is too leveraged, and trust, once broken, can't be repaired with money. The collapse is coming. The only question is timing and whether you're prepared, or will be caught like everyone else, thinking banks are safe, until yours isn't. The pattern is always the same. The crisis builds slowly, invisibly, in balance sheets and funding markets. Unrealized losses accumulate, liquidity drains, stress increases, but nothing breaks. Everything appears stable until it doesn't. Until one bank fails, one unexpected shock. Then contagion spreads. Instantly, confidence evaporates. Depositors run, not just from weak banks, from all banks, because nobody knows who's next, who has the most exposure, the most unrealized losses, the least liquidity. In panic, Everyone runs, and the runs create the failures. Banks that could have survived with stable funding fail under withdrawals, must sell assets at losses, realize the unrealized, become insolvent. The prophecy fulfills itself. And the Fed steps in, creates emergency facilities, lends unlimited amounts, guarantees deposits, backstops the system. Just like 2008, just like March 2023, but each time, the cost is higher, the intervention larger, the moral hazard deeper, and the trust, thinner. Because people are learning slowly, painfully, that banks aren't safe just because regulators say so. That capital ratios are accounting fictions, that stress tests test the wrong things, that the system is designed to appear stable until it collapses. And when it collapses, your deposits are at risk. Not because the FDIC won't pay, they will, eventually. But the delay matters. The chaos matters. The frozen accounts, the unavailable money, the uncertainty. How long can you survive without access to your deposits? Days, weeks, and if you have more than $250,000, the insurance limit, everything above that is unsecured. You're a creditor waiting in line with bondholders, behind the FDIC, behind secured creditors. You might get cents on the dollar. Might get nothing. The legal structure is clear. Depositors are unsecured creditors. Always have been. Most just don't know it until their bank fails. Then they learn expensively. The commercial real estate time bomb is just beginning. Loans originated in 2018 through 2021 were underwritten at 3% rates. Assumed refinancing would be available at similar rates. Those loans are maturing now. 2024, 2025, 2026, $300 billion maturing annually, needing refinancing at 5%. The debt service isn't supportable. Occupancy is down. Rents are down. Values are down 30 to 50% in many markets. The loan-to-value ratios are underwater. Banks won't refinance underwater loans without additional collateral, additional equity. Property owners don't have it, can't raise it. Values are falling. Who invests in a falling market? The loans default. Banks take possession, sell Ach, losses or hold and hope. Most are holding, hoping values recover, hoping rates fall, hoping the Fed pivots, but hope isn't a strategy, and the losses are mounting. Regional banks like New York Community Bank Corp reported massive commercial real estate losses in early 2024. Cut dividends, stock collapsed 70%. Other banks are hiding similar problems, using Ixandan, pretend, modifying loan terms, delaying recognition, but eventually the losses must be realized, the capital must be raised, or the bank must fail. And there's a darker possibility that regulators know all this. No banks are insolvent on a mark-to-market basis. No, the liquidity is insufficient. No, the system is fragile. And I've decided the best strategy is to hide it, delay recognition, extend the fictions. Because acknowledging the problem would create the crisis, would trigger runs, would force failures. So they maintain the illusion, keep banks open, keep reporting them as adequately capitalized, keep passing them on stress tests, while privately ... monitoring closely, preparing contingency plans, drafting emergency authorities, getting ready for the inevitable because they know it's coming, just don't know when, and can't prevent it, can only prepare for it, which means you should prepare to, because when it starts ... there's no time. The run happens in hours, the failures cascade in days. By the time you hear about it on the news ... it's too late. Your bank is closed, your deposits are frozen, your access is blocked, and you're waiting, like everyone else, for resolution, for payout, for return to normalcy. That takes weeks, months, maybe longer. Can you survive that? Have you planned for it? Or are you trusting the system, believing stability is real? Assuming your bank is different, that liquidity is abundant, that the Fed will save everyone. The Fed can save the system, can create unlimited liquidity through emergency programs. K guarantee. Deposits through the FDIC and Treasury backstop can prevent total collapse, but they can't prevent individual failures. Can't protect every bank. Can't guarantee your bank survives. The system survives. Your bank might not, and the resolution process, even when successful, takes time, causes disruption, creates losses, particularly for uninsured depositors, for businesses, for people with complex banking relationships. The social cost is high even when the system doesn't collapse. Jobs lost, businesses closed, communities damaged, all because banks took risks with your deposits. Invested in long-duration bonds, failed to hedge interest rate exposure, mismanaged liquidity, and regulators allowed it, approved it, signed off on capital adequacy, gave clean audits until the run happened. Then suddenly ... those same regulators declare the bank failed, was inadequately capitalized, was poorly managed, was taking excessive risk. The same bank they approved 6 months earlier. The narrative changes after failure. Blame is assigned. Depositors are told they should have known, should have monitored, should have diversified, as if retail depositors have the tools, the expertise, the information to evaluate bank balance sheets, to assess unrealized losses, to predict liquidity crisis. You can't. The system is designed to be opaque, complex, impenetrably until it's too late. Wake up. The liquidity is draining. $620 billion in unrealized losses sitting on bank balance sheets. The Fed's emergency program expires March 2024. Quantitative tightening continues. Deposit flight accelerates. Commercial real estate defaults are rising. Overnight funding markets are stressed. Regional banks are vulnerable. Community banks are exposed. And the system that survived March 2023 survived because of temporary programs that are ending. While the vulnerabilities remain larger now, more dangerous, more certain to cause failures. The banks don't tell you this. Report profits, declare dividends, maintain facades, while sitting on losses that would wipe out capital if recognized. While depending on liquidity that's disappearing, while vulnerable to runs, they can't survive. And regulators stay quiet. Issue bland statements about monitoring, about adequate capitalization, about systemic stability, while knowing the truth that the system is fragile, that failures are likely, that the crisis is building slowly, invisibly, until suddenly it breaks. And when it does, the losses won't be theirs, will be yours, your deposits, your business, your financial life, frozen, disrupted, destroyed, because you trusted, believed, assumed safety where none existed. The liquidity implosion is coming. The only questions are when and how many banks fail, and whether yours is among them. Prepare accordingly, or don't. The system doesn't care. It will collapse with or without your awareness, but your survival depends on seeing what's hidden, acting before panic, protecting what's yours, while you still can